Hello and welcome to Fintech Insider Insights. I'm Kate Moody, Strategy Director at 11FS. This episode we'll be discussing, has fintech grown up? We'll be asking whether fintech is now a mature sector. It's gone from attracting massive funding in the late 2010s and immediately following the pandemic to enduring a funding crunch in the last couple of years. And as investors start to cautiously return to fintech, how can companies move towards a more sustainable model of growth? I'm joined by a really exciting lineup of experts from in and around the sector, a founder, an investor, and a journalist to give their perspectives on this next phase in the development of fintech. First up, we have a warm Fintech Insider welcome to a returning guest, Devin Kohli, co-founder and general partner at Outward VC. What have you been up to since you were last on the podcast, Devin? And what should our listeners know about the work that you do at Outward?
Well, thanks for having me. Pleasure to be back. So at Outward, we are a early stage fintech fund. We're investing predominantly in the UK and trying to pick category winners across fintech and the connected sectors. So that's areas where we see big society shifts over the next 10 years in healthcare, in real estate, in provisions of climate as well. We set up the fund in 2017-18. And we're looking forward to investing in the next 25 to 30 companies in the coming year or two.
Awesome. Well, yeah, thank you very much for taking the time to come and share perspectives with us. In another very welcome return to the podcast, we have Romi Savova, founder and CEO at PensionBee. Great to have you back on the podcast, Romi. I know from following PensionBee, you guys have been very busy with your rollout in the States. I'm guessing it's been a hectic time. What else is going on in the world of PensionBee and with yourself?
It has been a very hectic time with lots of traveling across the pond. I'm really looking forward to this episode because I think growing up is definitely the theme of the day. We've taken a pretty unique route. We went public, and I think I was probably with you when we were still a private company. So it's definitely been quite a growing up journey. And yes, as you said, our big news is that we are global. So look forward to discussing that more too.
Awesome. Well, yeah, thank you very much for taking the time in amongst the hecticness to come and share your insights as well. And we have a Fintech Insider debut for Callum Burroughs, Fintech and Startups correspondent at Business Insider. Welcome to the podcast, Callum. Always really useful and interesting to have journalists on the show. So looking forward to hearing from your takes as well. Tell us a bit about your role at Business Insider.
I've been at Business Insider for nearly 6 years now. And to be honest, this is pretty much the pinnacle now, getting invited onto the podcast. I've been buzzing all day, calling friends and family, celebrating. It really feels like it doesn't get much better than this. And I've been covering fintech in various guises now for, I'd say, a good 5 years. Having previously covered the banking sector, but I'm not just exclusively focused on that. We also cover a lot of, inevitably AI, but everything from rapid grocery delivery to e-scooters when that was still a thing, and any and all of the sort of madnesses that VCs like to put their time and money into in the wider tech market.
What an awesome spectrum. Well, I mean, first and foremost, thank you for adding some more listeners to the show. So I hope they're enjoying listening in. Well, thank you for joining us as well. Let's jump in. As always, got lots to cover. To kick off the show, we'll be looking back at how early fintech exploded onto the scene and then struggled as market conditions got tough. How did the sector go from a niche curiosity to one of the emergent giants of the tech industry? And as the global economy was battered by the energy crisis and soaring inflation, why was fintech so vulnerable to those headwinds? I suppose, just to kick us off, really, let's talk about what we might describe as the first fintech golden age. Callum, you mentioned you've been covering fintech for a little while now. When did you first get a sense that the FS world was starting to take fintech seriously?
Yeah, that's a good question. I mean, I covered markets and banking sort of for about a year before making what was then considered a bit of a plunge from the finance team to the tech team at Business Insider. And actually, the story that really got me interested in what we considered to be the sort of next wave of things was when JP Morgan was sort of reportedly being a bank within a bank, which later became Chase, of course. And the conversations that I had at the time with some of the emergent sort of fintech founders and CEOs who I hadn't really dealt with at any point on that journey, but seemed to have a real confidence and a bullishness in what they were doing, which you tend to expect from bankers, frankly, but you also tend to see in people with a real conviction of where they're going. And in a lot of cases, those have proven to be very, very successful business models, albeit with some bumps in the road, as discussed. And I think in that sense, the idea that financial services was not an industry that was necessarily, lacking in any sense, but certainly had a lot of issues that weren't being dealt with, and that there was a sort of not just one, but a whole field of challenges to that market, felt like an opportunity that was maybe too big to pass up, and so it's proven to be very disruptive as well.
Yeah, no, absolutely. And Romi, obviously, you founded PensionBee back in 2014, so that's a long time ago. Like, a lot of amazing things have happened for you in your business since. But can you remember what was it like at that time being an entrant into the fintech sector?
I can absolutely remember it. It was very exciting. It was very new, and swathes of the fintech sector had not yet even come into existence or had any entrance. So we were very much at PensionBee focused on pensions, of course. And back in 2014, I can't recall really looking around and seeing other companies focused on revolutionizing pensions or making pensions better for the consumer. So it was very much still uncharted territory. There had been a couple of larger companies that had had some funding rounds, probably a couple of Series A, maybe a Series B here and there, but generally it was all still very new. I think fintech advertising was just starting to emerge, and I very distinctly remember walking past a Wise billboard back then, and thinking, oh, this looks kind of interesting. So it was, it was definitely emerging into the mainstream, but still very exciting, a little bit unexplored, and definitely the next challenge if you are, a kind of financial services professional for life, as I suppose I have been.
Yeah, no, for sure. And Devin, I suppose from the investor's perspective, when do you think it was that fintech actually started to take off? When did investors start to really notice this space and take an interest in it?
Yeah. I mean, for my sins before in venture capital, I was an investment banker covering technology. And I think there was a lot of innovation. There was a lot of more of the fin and less of the tech, but innovation in fin. So more structuring and all of that stuff going on in the sort of late 2000s going into 2010. And I think, what you started to see with the likes of ClearScore and the likes of TransferWise is, to the consumer, you started to see clear, tangible changes. It's like, oh, I'm not going to get fleeced when I send my money across the world. Okay, can get my credit check without going through 25 pages of signing things, and I can see my statements on my mobile. That's type of era which was starting to come through in 2010, and I think the pioneers of that, TransferWise is obviously Wise now, is a very good example. Is when you started to see people wake up, and then you had the likes of Silicon Roundabout and the likes of politicians sort of galvanizing around that area, and you had pioneering funds like Seed Camp at the early stage who'd started to invest in some of these companies. So I think it was around the turn of the decade of 2010 that I feel that things started to really shift, 11, 12, where you start to see that some of these companies emerge, and you're like, oh, wait, hey, hang on, something's going on here. And I think obviously there's a lag factor. Always there's a lag factor, and you have to factor that in. So that by 2013, 14, some of the companies which were first funded are now started to emerge, and they're doing their first substantive rounds of funding, and they're starting to produce products which you can touch and feel. I think that was the era where you started to say something interesting was bubbling, and it was bubbling right here in the city of London.
Yeah, no, such a key early hub. I mean, Romi, how easy was it to explain to people at that time, maybe who weren't immersed in financial services, like what it was you were doing or what fintech was? Like, did kind of your friends, did your family kind of get it? Did they understand?
Well, I had started my career in investment banking, and it was still quite difficult to explain to a number of people that banking can have many different shapes and forms. So I wouldn't say that finance in particular is well understood, let alone fintech. And so, I think explaining to people what PensionBee was all about was in some ways a little bit easier, because most people did and do have some sort of pension that they've acquired. They know very little about it. and are hungry for knowledge and just understanding more about that really important aspect of their savings, which in many cases can be bigger than your bank account, bigger than your house, but still kind of, mired in kind of complexity and jargon. So I actually found it was quite quite well received when I spoke to lots of people about their pensions, even if it didn't make me the most exciting guest. I think if you can find that relatability to the consumer and what it is that your product does for them, then you're in pretty good territory.
No, for sure. Callum, what was the first of like the early fintechs that you personally became aware of? Can you remember where you first were when you first came across a fintech?
Yeah, it's funny. I was actually thinking about this just before we started recording, because it almost felt a bit prescient for me. I lived in France very briefly before I started working for Business Insider. I'd taken some time out between jobs to travel and live abroad. And while I was working abroad, I needed to find a way to receive money for invoicing when I was freelancing. And I stumbled across TransferWise. And I thought, hang on a minute, isn't this supposed to be really, really expensive? And I remember thinking I'd looked at what my bank was offering, and I remember calling around a few friends and saying is there a way of doing this so that I can exchange what I'm receiving in euros or dollars from companies I'm invoicing into, or pounds even, into euros without a fee? And, a bit of digging found that option for me. And I remember thinking, this is great. This is such a much better process for me than what I'd been able to experience previously. But I think probably the biggest thing was actually, as I mentioned earlier, the conversations that I had subsequent to learning a little bit more about the tech side of financial services and how that was developing, not just within banks themselves, but people leaving banks and going out and doing their own thing. I remember having an interview with Nick Stronsky, of course, of Revolut, and Tom Blomfield when he was still at Monzo, and being really blown away by not just the scale of what they wanted to achieve at the time, but also the sense that this was such a greenfield opportunity, that there was so much to be done, that they themselves knew that this was not going to be something that was a flash in the pan. There had to be a level of engagement beyond that. And I think that is very exciting anyway. But I think particularly when you're a reporter at that sort of quite nascent knife edge of these things, it felt like all the money and all the attention was being drawn towards these businesses, particularly in London at the time, but also, N26 was around before as well.
Yeah. And I suppose, Devin, we've talked about maybe Romi's experience in 2014 and how some of these other fintechs sort of started to grab people's attention throughout the 2010s. I suppose we saw an increase in interest in fintech, increase in funding in fintech, all the way up until, I suppose, what people have described as this boom in 2021, right? So talk us through that maybe. What took us to that point? What fueled that growth in fintech up to the point of 2021? Was it a boom? How would you see it?
I think it was definitely a boom, and it was fueled by exuberance on a number of sides of a marketplace. It's, I think, first of all, you had the opportunity cost. There was very low interest rates. So you therefore had an decade of low interest rates coming into COVID, where effectively venture capital became a very, very interesting asset class for a lot of people, which promised very strong returns. Within that, financial services as a part of venture capital was perceived as a huge value creation opportunity because of the sheer numbers involved. So within fintech, you had an intro. Within venture capital, fintech was perceived as sort of the golden goose. Added to that, you had a wave of capital and oversupply of capital, and then you had going into that, which was itself sort of added to by ever increasing valuations, and then you had a bit of a FOMO issue of people going, well, I didn't get in, now I want to continue to get in later, and so you had pushing up a valuation. You had on the other side, you had I think another aspect was the rise of other areas. As you digitalized parts of the economy throughout the 2010s, you had rises of e-commerce, you had a rise of alternatives, which allowed people more access to these products. So you had these products, particularly on the consumer side, fueled by more money getting into more people's hands, and therefore the sort of cycle carried on. That, oh my god, it's sort of it's a train which is fast going, and we need to jump on it. And then to icing on the cake, you had the pandemic, and of course, I think that's where there was a sense that we're moving to very quickly a digital world, and even more so than we were before, which fueled even more speculative investment and more speculative valuations. So I think all of these things sort of came in a sequence, starting off with low interest rates and opportunity cost, added to the sort of behavioral aspects of e-commerce and digitalization. And on top of that, a pandemic, which forced people to have more time on their hands, and from a consumer perspective, but from an investor's perspective, felt that there was only one way. And I think that's where, we kind of lost our mind a little bit in certain aspects.
Romi, how much of Devin's description resonates with you? I mean, and what was it like to actually run a fintech across that trajectory?
I think quite a lot of the description is very spot on when you take a step back and just look at the last decade and how things evolved, and you can take that step back and look at it from, a slightly more detached point of view. If you think about, living through that, you may see it a little bit differently, I suspect. I suppose what a lot of entrepreneurs have to consider is that in order to grow a business quickly, you do need to invest. And in order to invest, you generally need to run at a loss. And that loss needs to be funded in some shape or form. And to fund the loss, you need to give up some sort of equity in your company. And, that is a funding transaction that in fast growth companies tends to repeat itself and repeat itself and repeat itself. But, the bigger the loss is, kind of the more you need to fund, the more vulnerable you are to the music eventually stopping. And I think that you do need to always bear that at the back of your mind, that, funding a loss is always going to have some element of sort of risk attached to it, some element of negotiation attached to it, and how available is the money. And I think what we also found towards the end of 2021, I suppose, kind of beginning of 2022, is that the money became a little bit less available, and therefore the negotiating power, I suspect, shifted a little bit from the really fast growing fintech where it's hard to get in the round and get a piece of the action, to, well, actually there's quite a lot of companies that need money right now because the losses have grown so big. And so there is that element as well from the company managerial perspective that also made the music stop just at that particular moment. For us, I suppose we always did take a slightly different path. I mean, we didn't really go global, we didn't go international until we were about 10 years into the journey. And so funding the loss was never quite as sort of cliff edge as it could have been. And we've obviously recently turned profitable. So we kind of ran it in line with our plan. And I think it is probably a little bit harder if you're being forced to turn profitable at a time, that is out of line with your plan. So from the entrepreneur's perspective, it can be a little bit disruptive that there's all these changes going on around you that you have no control over, that are actually acutely impacting the business model. But I suppose everyone can take comfort in the fact that every industry has this kind of cycle, and it's just a matter of when will it top and when will it bottom.
Yeah, no, I think that's key. I mean, Callum, would you share that perspective? Does every industry go through a similar cycle, or have there been elements of this that have been unique to fintech?
Yeah, I think that's a really interesting way of putting it, because I remember very distinctly during the sort of 2020, 2021 boom cycle of COVID, there was an overexuberance everywhere. But I think crucially to Romi's point is that people didn't think the music was going to stop. And the general conversation that I had both with investors and with founders in that time was a sense that things are going up and to the right. And if you're not going up and to the right with all the funding that you're getting, then someone else is. And so you're going to lose market share. You're going to lose out on the competitive advantage that you built, your tech moat, whatever it may be, if you're not doing this. So you do need to expand to new markets. You do need to launch that product quicker than you might have done previously. And I think that was probably true in a lot of industries, not just in financial services and fintech more generally. But I think that we'll come on to it, I'm sure, but the inevitable point then was that there always needs to be someone else to fund the next round at the next higher valuation. And there was a sense during that time that, as Devin notes very clearly, like there was a low interest rate environment, there was a sort of stimmy check sort of mentality that there was always going to be more money coming in, and that people did have more disposable income, perhaps both funds and individuals. And so when that music did stop and those investors did take stock and founders did realize how much they actually had to do with the money they had, I think it became that great quote of businesses perhaps dying of indigestion, maybe rather than starvation towards the end.
And just to add into that, I think it's well documented there was an overexuberance in valuation at the Series C and later stage or scale up stage. I would also say that during that 2018-19 to 21-2 particular high of the market, there was not only an oversupply of capital, there was arguably an oversupply of people wanting or thinking, or there was tourist capital, but there was always tourist founding teams as well. People who thought, you know what, this is something which is clearly taking off, I want to get involved, not necessarily building a business which had a clear mode or was solving a clear problem. And so you had a kind of a plethora of many companies doing very similar things at the same stage. And that not all of them are going to make it, or there are companies which shouldn't have been backed in the first place being funded because capital had to find a home. So, and whereas the big corrections, as we'll probably come and talk about, happened at the later stage, where there was also this wave of tourist venture founders coming in, whether it was Web3, remember that soul cycle, or Bitcoin, or whatever it was, coming in and saying, I want to set up a business in this field. And that took capital away too. So in the overexuberance was on both sides of the marketplace.
Yeah, no, I think that's a really fair point. And I think lots of people have talked about maybe 2021, kind of the end of that boom cycle, marking almost like the end of what we might describe as like the first phase of fintech. I mean, Romi, would you recognize that description? And if so, what do you think are kind of the legacies of that first phase?
Is it the end? It doesn't feel like the end. I think it's the end for some, but for many of the companies that were built over that decade, I think it's it's sort of the endurance that really sticks out to me, and the fact that we have some, particularly in the UK, and the same can be said of the US, but particularly that we have so many kind of well-known financial technology companies that have become embedded in the fabric of society. And I focus on the consumer space in particular, and I can think of a number of financial technology brands that are incredibly well known and that have changed consumers' lives and changed those financial sectors. So is it the end? I'm not sure. I think it's the continuation, but there is definitely an inflection point where if you got big enough, if you got strong enough during that period while the funding was available in ways that it's not today, then I think that you're actually in a very strong position, and you kind of see it as the part of the cycle where you cement your competitive advantage.
Yeah, no, I think that's really true. Okay, we're going to take a quick pause here for a very quick break before we explore how fintech's next phase of growth can be more sustainable. It's all coming up after this super quick break, so don't go anywhere.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Welcome back to Fintech Insider Insights, where this week we're asking the question, has fintech grown up? Before the break, we talked about the first great boom and bust that we've seen in fintech. Now, as the sector looks poised to recover from a bruising 2023, we want to look at how major players in the market can pursue a better, more durable kind of growth. Okay, Callum, how can fintechs pursue sustainable growth? What do you think this next phase of fintech looks like?
Yeah, I think it obviously massively depends on the sector and the type of industry that a company is working in. I think one of the things that the sort of overexuberance that we mentioned allowed for was, I think, a sense that you could move fast and break things because growth at all costs was the sort of modus operandi of the sector. And I think not just in fintech, I think, people like to sort of comment that VCs can often be sheep-like, but I do think sometimes, to Devin's point, when you have a group of founders who all kind of somewhat drink the Kool-Aid around a certain topic or an idea of something that's going to be successful, I think it can be quite easy to get a group think on that. And so I think there have been notable examples of particularly, large fintechs, later stage businesses that have looked to expand overseas, particularly to the US, for example, and found it to be a massive, expensive, difficult challenge from both a regulatory and from a consumer perspective, and have been burned by those experiences. And some may go back and some may not, but that's not exclusively true as a market opportunity. There are other markets that companies have gone to in the hope that the fintech sector there might be exciting. And I think that actually those learnings tend to be very chastening for businesses, but they are good learning opportunities. So I think that the market conditions have tightened, and I think that probably forms the basis for what I would consider to be more prudent growth anyway. I think companies that have focused around their core business and made sure that they are actually making money, not just sort of growing sort of nice top line numbers and sort of flattering to deceive, but genuinely making money on the products that they said they would, and really like hunkering down on those points, have tended to be the ones that have been most successful as we now emerge from some of this dearth of funding. And I think it's also crucial to note that, I think as we just mentioned, some of those companies raised a lot of money during the peak of the market at very high valuations, but then haven't actually needed to raise since. And even some companies that raised, a down round or two even during those periods have then gone on to actually grow back into the valuations that they had before. And so I don't think that the lesson there is that trying is bad, but there are companies that tried well and wanted to do the right thing and failed, but came again, and those that were actually not doing the right thing to begin with. So I think going forward, that sustainability point has been baked in. There just isn't the money to do everything anymore. So you do some things well and go from there.
Devin, I suppose when fintechs are now coming across your desk now, are you looking for different things? Are you asking different questions? What does that conversation look like for you in 2023, 2024 versus how it might have looked earlier on?
Yeah, I think we prioritize a lot more on the founder than the company itself. So we spend a lot more at the early stage. You're going in a 10-year relationship with the founding team here, or potentially longer. So whilst obviously the business has to stack up, they have to be solving a clear problem. There has to be the general view that most VCs would take is, clear moat, what do they do, competitive analysis, the usual things that you expect. You're actually we are disproportionately spending a lot of time on our founding teams, and you're looking at resilience check, you're looking at how they get themselves out of difficult situations, how they work with teams, because what we saw over the last 5 years or 7 years is you had a huge bull market and then a bear market, and the best founders were the ones who were nimble enough to see things coming, were able to get themselves out, as I said, of quite difficult situations, adapt. And those characteristics are things which the next 5 to 10 years will also have. And we actually, this analysis is quite interesting. Like, we worked with organizational development specialists to really see what worked with our founders, the ones who've been successful over the last 5-7 years, and what were the characteristics which were common amongst them. And should we, when we're looking at diligencing a company, apart from the usual things you'd expect to look at a company, look at those founder characteristics to see, can they sell in difficult markets? Are they ability to articulate clearly? You can have a phenomenal founding team, but if they can't sell their own product, then we've got a problem, right? You've got, others about human interaction, how they engage with people. And then, as I say, what challenges, personal and business, have they been through in their past, which has allowed them to perhaps have a more different and a more probably educated way of challenging the next few things that go on in the next few years. So I feel we're over-indexing on the founders. There are obviously new waves of fintech and new areas of opportunity which are coming up, which we are also looking at. But I think, the desire that when we're investing at the early stage, we're already looking at what their year 5 cost line is going to be, is you can't do that. right? It's just impossible. Anyone who tells you they can do that is, I think, a bit of doing a bit of a Pinocchio, because I feel like business forecasts change considerably. When we are looking at the sustainability of a business and the efficiency of a business, that doesn't mean that, we're saying, oh, if you're not profitable in 3 years, we're not going to invest in you, because that's also, I don't think, the right approach. Going back to some of the comments earlier, what we did see, which was striking, is this over-exuberance point also went to founders in terms of over-hiring. What we've seen in the last year and a half is you've seen businesses, certainly in our portfolio, which I can speak to, that have grown quite considerably whilst reducing their headcount and making themselves more efficient in the process. So why were they over-hiring in the first place? And so I think that's a question which they're asking. How can they be more efficient with what they already have, whilst not impacting their top line and therefore already improving their bottom line?
No, that's really interesting. Obviously, Romi, Devin's mainly focuses on early stage businesses. You guys are an early stage business, but are there any overlaps with the types of questions that your investors are asking of you? Like, how has that kind of investor relationship shifted for an established business such as PensionBee?
Well, we are in the public arena. So I would say that, for us, things are a little bit different. And because in the public market, nobody really gets a view into the inside of, the day to day or the week by week, as as someone may have had when you were a private company. There is quite a heavy reliance that is placed on kind of your word, the guidance that you give, the promises that you make, and so on. And, I would say that in public markets, because there is that information asymmetry between what the company knows and what the management team knows and what the investors are allowed to see at any given point, you do have to be quite focused on, ensuring that the financial predictions that you make are very much in line with the reality that you actually expect. And so, it makes sense if you have a predictable business model. It makes sense if you have a good kind of gauge as to, how you will grow, how much you'll spend on marketing, how many customers that will get you, how much revenue you'll make, how much of that revenue will be recurring and predictable. And then, of course, your cost base. But, I would say that your word is pretty important. And I think investors do probably look at you with a slightly different, possibly more skeptical lens when you are presenting yourself. But I think the fundamentals of sort of building trust, building relationships, in investing in, helping investors get to know you, get to know the business, understand why the business is long-term successful, what is the role of the business in this world more broadly. Those things I have actually found to be pretty similar. We at PensionBee, we've had this golden rule kind of since day zero, which is that we will always report quarterly. So for us, I've been reporting quarterly for the past 10 years. It's just that now that we're public, the report looks a little different. So I think those principles of good communication, rapid, frequent communication, I think that they are enduring.
Yeah, no, that sounds really, really key. Callum, I thought it was interesting. Earlier on the show, you were talking about one of your first kind of interactions with fintech being JP Morgan, talking about building something. I think obviously in this new age of fintech, we're still trying to work out kind of what the role of incumbent or traditional banks, whatever phrases you want to use. There was maybe a sort of initial idea that fintech was going to have the kind of Kodak moment of making incumbents obsolescent. I don't think we've seen that. What do you think the future actually looks like for the relationship between fintechs and incumbents?
Yeah, it's I've had it on both sides, and I think that there's sometimes a bit of a how do you put that? I think that I like and I really value, and I think it's why the sector is a very interesting one to cover and has been for a long time, that there is a real bullishness from fintech founders, particularly because a lot of the sort of technically gifted, talented people who go on to become founders, the tenacity that they bring tends to be something that rankles maybe their idea of what they consider kind of corporate life to be, sort of working in financial services. But the sort of phrase of eating the lunch of banks was always going to be sort of kind of nonsense, really, in my view. Like the crux of the early consumer like focus in fintech for me was, I think, so key in pointing out to anyone, but particularly users, that some of these products were terrible and there was no competition and there was no incentive to change and improve things. And it's only through that really sort of aggressive, often pushes into that we have things like using an ATM abroad for free, or low FX fees on the very consumer banking side of things, but also being able to see your pension online, having a dashboard where you can look at all of your, even things like, travel insurance, prepaid SIM cards. These are all things that, you'd have to find different services for at great expense previously that have now been simplified for anyone using it. And that is in line with what people expect as tech improves. But I don't think that I look at the valuations of even some of the biggest fintech players and think that, when they do often eclipse those of banks, when you look at the actual numbers involved, it's still very different. And I do still think that in a lot of cases, when I do speak to people on the bank side of things, there's a sort of, a quiet chuckle of, yeah, well, they're doing some, these guys are doing some really great stuff and we'll probably help lead their IPO. We'll take them public. They're still looking almost down in a sort of, I don't know, in a sibling way, like a younger sibling way than necessarily as a kind of as a peer or an equal. So I still think there's quite a lot of change to come there, but I don't think it's going to be happening anytime soon.
I'm intrigued what your experience is now, Romi. Like, if you're at industry events with maybe established firms or so in the pensions space, do they treat you differently now? Are they asking different questions, or what's the vibe now?
It varies. In some of these events, I do see us as being part of the industry, and we hold the same seat at the table. That's that has definitely been a change to the early days. But at the same time, I think, especially over the last few years, a few of the incumbents have gotten back into their older ways of thinking, because some of that pressure has lessened, to Callum's point. And you can absolutely, take that as, quite frankly, a compliment that you're still sort of seen as the fresh face of the industry, even if you have been around for the past decade. So I think it's really up to the fintech what they, what they choose to make of that. One thing's for sure, I think if you compare the growth rates, for those that have had the investment over the past decade, that have established their position in the market. If you compare the growth rate to the incumbent growth rate, I suspect the fintechs are still growing more quickly, and it is cyclical, and it is only a matter of time before people take another closer look and realize that these growth rates are wildly different, and how much better is it to be invested in a rapidly growing profitable company than in a slow growing profitable company.
Yeah, no, absolutely. I suppose, Devin, I don't know if this is a fair question to throw to you, but when I'm speaking to people at incumbent organizations, I'm always kind of, I don't know, still surprised by how entrenched they are in their established business models. Whereas when you speak to people at fintechs, they're always kind of thinking about all these different ways that they could take a problem that they're seeing in the market and then find ways to monetize that, and really thinking about that in more creative ways. I suppose, do you kind of still see that as a point of differentiation between the fintechs that you're maybe looking to back and the incumbents they might be challenging, or is that less of a factor?
I think a lot of that comes down to culture, by the way. A fintech, by its nature, is founded by the people who are still probably running it. So the DNA of the culture is to be entrepreneurial and to think nimbly and smartly. A large incumbent, not always, but largely, is run by professional management, right? They're not thinking in the same way as a founding team. So their culture that beds down from that is very different. You do get first generation incumbents very quickly, which emerge. But I think the culture is one point. And I think the second thing is that I think increasingly what was seen as window dressing by some of the large incumbents, we're going to put some team on innovation and we'll lock them in a room downstairs and never hear from them, is not sustainable anymore, because they're getting their market shares in some instances quite quickly taken away. So I think they are forced in this instance to now embrace fintech, and whether that means, not taking on fintech, but working with them on partnerships. And you're seeing a lot more of that, and a more evolutionary way of dealing with it. And that's been both B2B and B2C. And that's great to see. And I think that's also internationalizing as well. You're seeing British fintechs going to the GCC and striking big deals there, where, that's a great thing to see. And we're actually seeing UK fintechs learning from China and India and other markets. And that's an interesting way to look at it, because they've gone through a different evolution. For example, in those countries, I used to spend a lot of time working in those two markets. They went through, selling 100,000 mobile phones a day. What they did with e-commerce, they completely missed the desktop revolution we went through and went straight to laptop and mobile. And so how they've interacted and built their legacy system, or they built their systems, completely different to how we did over here. So you're seeing this cross-pollination, and the winner out of all of this is the consumer, or the small business, or whoever the ultimate user is.
Yeah. Devin obviously alluded to internationalization of, I suppose, British businesses moving into other countries, Callum, but I assume there's also, there is obviously just a huge potential for fintech to continue to grow internationally. We've focused a lot of our chat so far on the UK because I suppose that's where we're grounded, and we've seen a lot of those early fintech trends emerge. But which markets are you most keeping an eye on? Where do you kind of think the most exciting growth is going to come from?
Yeah, I really just agree with Devin's point there as well. But I think it's more fundamental than that. I think one of the reasons that going forward we will see growth in fintech in all markets, and I think there are a few real standouts there, is that on the consumer side particularly, and I know it's true of B2B as well, but people really love these products. I think, it was easy to kind of look at the sort of early vanguard of adoption in some of the neobanks, or sort of, be it like, trading or insurance platforms or whatever it may have been, and have a lot of, very excited sort of early adopters. But I think now, it feels sort of odd to say that you might love your bank, but I think people don't expect much from banking, particularly post 2008. And I think generally, it sort of is up there with politicians in terms of what people tend to be least interested in wanting to engage with as a thing. But there's, I think, a genuine sense now that the tide has turned there. I think the trust levels that people have in their fintech products, I think, is substantially higher. And I think that growth tends to speak to that. And so I think it's not just a UK phenomenon, I think, to that point. And so I think when I speak to people about, really exciting sort of fintech hubs for engineers in Eastern Europe, for example, there's been a lot of excitement there. I think Turkey is obviously a massive market that's digitizing very quickly in that space as well. And I think you obviously have seen, the huge success of a lot of, new bank type players in South America, particularly in Brazil, and think that the size of the market there is so exponentially large compared to the UK that there must be opportunities for other similar plays in consumer spaces in that market. And West Africa is somewhere that I've written about a few times as well. And I genuinely believe that, inevitably, I think Africa is kind of the future anyway. But some countries in West Africa have really seen some of the regulatory changes come into action, which I think will develop some of those things as well. And again, to Devin's point, which I think is really prescient, it's the wider changes in tech precipitate improvement in what consumers expect. And the companies that have realized that and good onto those things early tend to be the ones that will be successful. I think they are now the ones that are looking to exploit that growth and those opportunities.
Yeah, no, completely agree. We're coming towards the sort of the close of the show, sadly. So I suppose we need to loop back to our original exam question. Has fintech grown up, Devin?
I think it's matured. Yeah, definitely. I guess that's the same as growing up. I think every industry has cycles, and I think we've gone through quite a growing cycle, a pain cycle, and now I think we're in quite a good area where new technologies are coming through, which are thinking about how we work and how we invest and how we live. And I think that's also going to transform the next wave of fintech. So I think and I think those who've managed to get through that decade or that period of time, particularly the bear market, I mean, there have been great learnings from that, and which we've talked about, about efficiency, about and other areas. So I think it has grown up. I think, and I think the only way it can grow up is having gone through different experiences. And I think having gone through probably the most a bull market you can imagine, and then followed by a pretty bearish market, is a good way to grow up and realize things in a different way. So yes, is the answer to your question.
And I guess, maybe I'll give you the closing words, Romi, but what do you want to see next? Like, what is the next phase of growth that you hope for fintech as a sector?
I suspect it will be profitable growth and distinguishing yourself on the basis of the growth plus the business model, plus, I think the reason why most of us come into fintech, which is to make a difference in the consumer's life, whether the consumer is, the person with a pension or whether it's a small business. I think continuing to make a difference, but doing it with profitable growth behind you.
Let's wait and see. That sadly wraps up today's discussion. We could have talked for a lot longer, I'm sure. Thank you so much for taking the time to join us, to share your perspectives with our listeners. Where can people find out more about you and the work that you and your companies are doing, Romi?
We are online at PensionBee.com.
Awesome. Devin?
Outwardvc.com or LinkedIn is either or.
Brilliant. And Callum, what about you?
I don't really tweet or X so much anymore, so LinkedIn tends to be the best place to find me, or you can check out my work on the Business Insider website.
Brilliant. And you can find me on LinkedIn. Also, cannot keep up with Twitter, too consumed with LinkedIn. But LinkedIn, Kate Moody, or drop me an email, kate@lenfest.com. Thank you for listening. If you like what you've heard, follow our podcast and don't forget to leave us a review. It helps us to make it better and helps others to find the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider and email podcast@lenfest.com. Thank you very much. Goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.